Perhaps the biggest macroeconomic event of the week will be the 15th meeting of the G20 on Saturday the 21st and Sunday the 22nd of November. This will be hosted by Saudi Arabia, but will take place virtually rather than in Riyadh, owing to the global pandemic. Entitled Realising Opportunities of the 21st Century for All, the three key themes of the summit will be creating equal opportunities, especially for women and children, climate change and innovation. It'll be interesting to see what comes of the summit. Although the more cynical among you may be tempted to say, well, probably not very much, at least looking at it from the narrow confines of investment, don't forget 2016's so-called Shanghai Accord, when central banks reportedly, allegedly, struck a deal to halt a drop in China's currency and weaken the US dollar to help stabilise financial markets. On the home front, the major feature will be the latest inflation figures on Wednesday the 18th of November. The key here is whether pay increases continue to lag increases in the cost of living, as that is not great for consumer spending. However, central bankers crave an increase in inflation toward their 2% target and now seem to be even welcoming a degree of overshoot if they can fashion one, not least as this will help the globe handle its colossal and ever-growing debt pile. By way of reminder, the last set of inflation readings were as follows for the month of September. 0.5% year-on-year according to the Consumer Price Index, or CPI, 0.7% based on the CPIH index, which includes housing costs and is the Bank of England's preferred measure, and 1.1% according to the Retail Price Index, or RPI, though this is no longer an officially recognised statistic. None of those suggest inflation is about to run away using prices as a benchmark, but the Austrian School of Economics views inflation in a different way, focusing more on money supply, at least in the early stages, which it argues in turn then leads to increased prices, at least if the supply of goods and services doesn't grow as fast. Using the Austrian viewpoint, we can see that UK money supply, using M2 as the benchmark, is growing very, very quickly. So this may be something to which all investors, and indeed workers and wage earners, need to pay attention. Switching to corporate announcements, around a dozen FTSE 100 firms are due to publish interim or final results, release an update, or host an annual general meeting, and a good number of mid and small cap stocks are due to do the same. They include the following, although some of these dates may still be subject to change. Bid target TalkTalk Telecom on Monday the 16th of November, Imperial Brands, Experian, HomeServe and Agreco on the 17th, Real Estate Investment Trust British Land, Utility SSE, Spirax Sarco Engineering, DCC and Halfords on the 18th. DIY retailer Kingfisher, Halma, Royal Mail and Jet2 on the 19th. And Sage, Softcat and Mitchells and Butlers will round the week off on Friday the 20th of November. But the company which could cause the biggest fuss in the week ahead just might be telecom's giant Vodafone. It's due to release its first half results on Monday the 16th of November, and then host an analyst day on the 17th. It's been a difficult year for the holders of the firm's stock, as the shares are down by a third over the past 12 months, compared to a fall of just under a fifth in the FTSE 100. If you pan further back, the picture's even worse. Vodafone shares are trading at their lowest level since spring 2002, when the tech, telecom and media bubble was collapsing, and the degree to which Vodafone had overpaid to buy German mobile network operator Mannesmann was becoming frighteningly clear. Perhaps this ongoing share price slump continues despite Chief Executive Nick Reed's moves to target better returns from the company's infrastructure assets, such as its mobile network towers, which the firm's looking to partially spin off next year, despite efforts to restructure the portfolio for the sale of New Zealand and Egypt and mergers in India and Australia, and despite the trend towards ever-growing data and video consumption by consumers via their mobile devices, and that's even before the widespread rollout of fifth-generation or 5G mobile networks. So, it does perhaps feel like the share price is being weighed down by the following. The balance sheet, which is burdened with €42 billion of net debt following the acquisition of Liberty Global's European cable TV assets. Fierce competition in the core German, Spanish, Italian and UK markets across mobile, broadband and cable. Those four countries generated 2/3 of profits last year. And also the effects of the COVID pandemic. Alongside its full-year results in May, Vodafone warned of a hit to income from roamed, cross-border calls and data use, thanks to the collapse in international travel, and also a danger that some customers could find it harder to pay their bills if they'd been furloughed or lost their job. July's first quarter update was no thing of beauty as a result, as service revenues fell 1.3% year-on-year on a like-for-like basis, with the core European markets down 2.6%. Besides looking at the trend in that quarterly revenue growth, analysts will then look to benchmark these first half results against two pieces of guidance that management's offered for the full year. The first is underlying adjusted profits, and that they will come in flat to slightly down. Based on the metric of EBITDA, or earnings before interest, taxes, depreciation and amortisation, the benchmark is last year's €15.7 billion, and the current analyst consensus forecast is for actually an 8% drop to €14.3 billion. The second metric, well, that's free cash flow, where management has targeted at least €5 billion before spectrum costs, which could still be hefty, depending on when auctions for 5G spectrum take place. That implies a drop from last year's €5.7 billion outcome when, for the record, spectrum costs were €1.6 billion, thanks mainly to an auction in Germany. Finally, we come to the dividend, which is paid in euros, and after a big cut to 9 cents a share in 2019, the first ever reduction in the company's distribution, Vodafone kept the payment unchanged in the fiscal year to March 2020. The company is looking to redevelop what it calls a progressive dividend policy, but analysts are looking for pretty much no change this year. That implies an unchanged first half payment this time around of around 4.5 euro cents, although currency movements may mean the figures move around a little bit more in sterling terms. Note that this final graphic does show the dividend progression in pence. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.